Welcome to Global Trade for Beginners. Many people shy away from global trade due to a lack of information and past failures. Our short courses are designed to help you understand international trade and make informed decisions. Follow our course instructions and you will be well prepared for your international trade transactions. Hello, I'm Adito Gumbadewoyin, an export consultant at Fortress 20 Global in Nigeria. In this episode, I will introduce you to structured trade finance. By the end of this course, you will understand the basics of structured trade finance and its importance in global trade. This course is perfect for beginners, covering the fundamental concepts and key ideas. The goals of learning about structured trade finance are to understand the basics, to learn what structured trade finance is and how it's different from traditional trade finance and its key elements in international trade. The second objective is to recognize its importance, to understand how structured trade finance helps manage risk and solve problems in global trade, including credit, political, and liquidity risk. The third is to identify financial tools. By using various finance tools in structured trade finance, such as letters of credit, trade credit, insurance, factoring, and securitization. This course will cover the definition of structured trade finance, the key aspects of structured trade finance, the key components of structured trade finance, the importance of structured trade finance in facilitating international trade, the risks associated with structured trade finance, and the conclusion. What is structured trade finance? Structured trade finance is a specialized area of trade finance that employs complex financial arrangements to assist with international trade and investment. Unlike traditional trade finance, which typically relies on simple loans or letters of credit, structured trade finance uses various financial tools and techniques to manage risk, enhance cash flow, and better support trade transactions. The key aspects of structured trade finance include complex financial structures. To meet the specific needs of a transaction, various financial products are used, including securitization, syndicated loans, and trade credit insurance. The second key aspect is risk mitigation. Different strategies are used to reduce common risk in international trade, such as the credit risk, political risk, and currency risk. The third is customized solutions. Finance solutions are customized to fit the specific needs of the parties involved, including detailed contract negotiations and tailored financial agreements. The fourth are collateral and guarantees. Collateral, guarantees, and other forms of security are used to back the financing and make sure it's repaid. The last is enhanced liquidity. Innovative financing solutions help trading companies improve their liquidity by freeing up working capital. What are the key components of structured trade finance? The first is trade credit insurance. This protects exporters from losses if buyers don't pay. They cover risks like defaults or insolvencies. The second is the letter of credit. The buyer's bank guarantees that the seller will get paid as long as certain conditions are met. It ensures that the buyer will pay for the goods and services as promised. The third is the bill of exchange. This is a document that allows the sellers to get paid or get a promise to be paid at a later date. The fourth is factoring and forfeiting. Factoring means selling receivables to a third party at a discount to get cash quickly. Forfeiting, on the other hand, means buying medium to long term receivables from exporters at a discount to provide immediate cash. The fifth is securitization. This involves turning trade receivables or other assets into securities that can be sold to investors, giving the seller cash. The sixth is the structured trade finance facilities. These are custom financial arrangements like syndicated loans where multiple lenders fund a large trade transaction. The next are collaterals and guarantees. This involves using third-party guarantees to secure financing such as property or inventory. Then we have the eight components of structured trade finance, which are forward contracts and options. These financial tools are used to protect against changes in currency and commodity prices, and they help to stabilize costs. The last is the performance bond and guarantee. These are in place to ensure that the seller meets contractual obligations. If they don't, the buyer can claim compensation. Structured trade finance is important because of the following reasons. Number one, risk mitigation. It helps protect against risks like credit risk, political issues, and currency changes by offering insurance, guarantees, and hedging solutions. This shields both the exporters and the importers from potential losses. The second importance is improved liquidity. Solutions like factoring and forfeiting provide immediate cash by turning receivables into money. This helps businesses invest and manage their working capital. The third importance is enhanced access to capital. It allows businesses to get funding that might be hard to secure through traditional methods. Structured trade finance can be customized to meet specific needs. The fourth importance is the facilitation of large transactions. For big or complex trade deals, structured trade finance can arrange syndicated loans or other types of financing involving multiple parties. This makes it possible to manage transactions that might be too big for a single lender. We're still talking about the importance of structured trade finance. Number five is increased trade opportunities. By lowering risk and removing barriers, it helps businesses explore new markets and expand their trade possibilities. Number six is customization. Structured trade finance allows for tailored financial solutions that match the specific needs of everyone involved, making sure that the transaction terms fit the trade requirements. The seventh importance is efficiency and speed. Structured trade finance can make the trade process smoother by combining different financial tools into one plan, reducing delays and improving efficiency. Number eight is credit enhancement. It offers ways to boost creditworthiness, like using collaterals or other guarantees, making it easier for businesses to get finances and negotiate better terms. Structured trade finance offers many benefits, but comes with risks. Some of these risks are credit risk. This is the risk that the buyer or partner may not pay as expected. Even with insurance and guarantees, there's always a risk, especially in unstable markets. The second risk is political risk. This stems from political instability most times. Government actions or changes in regulations in the countries involved can affect transactions or the ability to get funds back. The third risk is the currency risk. Changes in exchange rates can affect the value of payments or the cost of financing. Managing this risk can be tricky with complex currency arrangements. The fourth risk is the legal and regulatory risk. Different countries have different laws and regulations. This can be complicated and costly to follow. Changes in laws can impact trade transactions and financing arrangements. Here are some additional risks associated with structured trade finance. Operational risk. This risk relates to mistakes in paperwork, mismanagement, or fraud by the parties involved. The sixth risk is the market risk. Changes in market conditions like price fluctuations can affect how profitable trade transactions are. Number seven is the liquidity risk. One party might have trouble meeting their financial obligations on time due to cash flow problems. Number eight is the counterparty risk. The financial institution or partner involved might not fulfill their obligations on time. Another risk, number nine, is the documentation risk. Structured trade finance deals with a lot of paperwork. Mistakes or inconsistencies in these documents can cause problems, delays, or even failed transactions. The last risk is the reputational risk. If there are negative outcomes or failures in these transactions, it can damage the reputation of the people or companies involved, which might hurt future business chances. To handle this risk, it's important to do careful research, manage the risk effectively, and use financial tools and insurance to protect against potential problems. In short, structured trade finance is key to making international trade work smoothly. It manages risk, it improves cash flow, and offers customized financial solutions. It's essential for handling complex global transactions and overcoming challenges in cross-border trade, making it a vital tool for global business. Let me take a little time to talk to you about our company, Fortress 20 Global, and what we do. Fortress 20 Global is a trade and export management company headquartered in Lagos, Nigeria. The company is dedicated to simplifying and enhancing intra-African and global trade. Our services include developing curriculum for international trade and related topics, providing online and in-person training and skill building, offering documentation assistance, arranging trade finance solutions, and much more. For customized training on international trade, AFCFTA, and other related topics, contact us by email. You can also request our latest training catalog by email info at fortress20global.com. Thanks for watching. Stay tuned for more videos on global trade and courses relating to global trade. Please like, comment, and share this video. Good luck with your international trade journey.